All right, hold on a second. It's a bit behind. All right, guys, I'm gonna go live. Going live, and we are live. Okay, guys, I think it's working. We are live. We're live. It's working. Okay, so.
Hi, guys.
Hey, how's it going?
Back.
I know. Welcome back.
Hello, everyone.
Again, we are ATX Homegirls. We go live every other Wednesday. My goodness, I'm not here today. We go live every other Wednesday at 7 p.m. Melissa, help me out here.
Central Standard Time, every Wednesday. We're going to be here. We're going to be in your face, talking about all things real estate, all things Austin.
Yes.
Any topic that would be of value to you is what we're going to talk about. And it's an unscripted YouTube series, so we're not going to be cheesy, following a script.
Yes.
We're just going to be talking to you, and then this is interactive, so comment with any questions, and we'll get the answer to you in real time. And if we can't do it in real time, we'll get it to you next time.
Exactly. Thank you, Melissa, for that. And again, guys, just a reminder, the topic for today is how do your taxes affect your ability to buy or sell real estate? And with that in mind, we did bring a special guest. We have a CPA here, Danny Pena, that's going to help us hopefully answer any questions that you may have. Again, we're just going to have a casual conversation. Everything's unscripted. We as realtors, we're going to ask questions to Danny, and Danny can hopefully help you be informed. And this may be something that you may or may not know. But before we begin, I want to introduce all of us here. My name is Liza Brazzil. I'm a local realtor. I have here the lovely Melissa Hudson. Melissa, say hi. And then to the bottom, I have Keena Habeeb. We are all local realtors. We're here providing content to you. Again, we're ATX Homegirls, and we love being here and helping you out. So again, Danny Pena, go ahead and tell us a little bit about yourself. Yes.
Hello, everyone. My name is Danny Pena. I'm from Austin, originally from Austin.
Yes.
I'm a CPA and licensed in the state of Texas. I got my license in 2015, and I've been working in this industry since 2002.
Nice.
I've been on my own since 2015 and filing lots and lots of tax returns, getting refunds, and getting people to pay as well. So
right. I bet you've seen a lot of things, right, Danny?
Yeah, I've seen a lot of fun stuff.
Well, it sounds like you love what you do. And thank you again for coming on board with us here to discuss real estate stuff. Because, you know, a lot of the CPAs, they also have to deal with realtors like ourselves or with lenders when it comes to a buyer purchasing property. And speaking of that, I don't think a lot of buyers may not be aware of this, but we're in tax season right now. Some buyers may have already filed their taxes, and some are still in the works of doing that.
Everybody's aware it's tax season.
Yeah. Well, what I was gonna say about that, I know, so sad, right? What I was gonna say on that topic was the deductions part. We want to minimize paying how much we pay in taxes, but some people get a little bit overboard on how much in deductions they claim. Yes. So Melissa, do you want to go a little bit deeper on what we want to discuss and maybe questions that we're going to ask for Danny?
I can probably use myself as an example. I found myself in a sticky situation when I got married in 2017. That summer before I got married, I was going to purchase a home with my now husband, and I was a realtor, so I was writing everything off I could. I'm a business owner. So if you're out there and you're a business owner, you know what it's like. It's a lot of expenses. You spend a lot of money on your business, more than people think, right? So yes. The money's coming in, it looks good. What can I write off? Well, when it came time for me to apply for the home loan, I found myself, it doesn't really show that I make much money. Mm-hmm. So maybe I'll let Danny go into why that happened to me and why it happens to a lot of folks.
Sure. So I guess when you say I'm a business owner, individuals that are sole proprietors, they work for themselves, they're self-employed, they earn income, they charge a fee for their services or their products. and they make X number of dollars, which is referred to as gross income. So in a year, I would receive payments from my clients for 100,000, 200,000, whatever that number is. That is your gross revenue. And the higher that number is, the better it is for you to qualify for a mortgage, for purchasing a home. However, that can be very expensive when it comes to do your taxes. So you write off your expenses, rent, telephone expense, supplies, advertising, stuff like that. So then you lower that $200,000 number and you get your net income. Well, that's the number that the lenders will look at as to say, this is how much money you have to make your mortgage payment. And that will determine how much they will let you borrow and, you know, what size of a house you can purchase. Lowering your income, lowering your gross revenue is very advantageous so that you don't pay as much in taxes. But it is going to work against you if you're trying to get a loan, you know, for a large amount. Here in Austin, I don't think you can get a house for 100,000 anymore. Is that right?
You can.
So
That'd be tough.
that's no good.
Yeah.
But you know that it is something that you have to know and understand. The more expenses you have, the less buying power you have.
So with
That's
that,
great.
so I'm sorry, Melissa, I didn't mean to cut you off. Go ahead.
No, I was just going to say that's good information. So, you know, Liza, Keena, Danny, are you surprised how many people don't know this?
Yeah, a lot of people do not know this, and that which leads to my other question. So, Danny, I don't know if you dealt with this before, but maybe there are some people out there that are in the middle of buying, and they may have already filed their tax returns and are probably in that sticky situation where they have to amend their return to show more income. Tell us a little bit more about that as far as time frames, what that entails, and all sorts of good stuff there.
Well, when you amend your income, that it to me is a strategy to say, yes, I do earn more money. However, you are gonna pay more in taxes, number one. Number two, when you say the time frame, it is my experience that amending tax returns does take a long time with the IRS. They're super busy. They get a lot of returns. Amending a tax return does take more processing time, which means that these amended returns could take anywhere from 2 months to 8 months, depending on how many people they have in that department, the IRS has in that department. So if the lender wants to see the results, if the lender wants to see the amended return being processed by the IRS, that could take quite a while. So amending it is not such a great deal for that regard. Basically, you are telling the IRS, I don't have these expenses anymore. That was a misstatement or what have you. And you're just going to end up owing more. And hopefully the lender understands that and can accept the fact that you have submitted the return and therefore they can accept it.
Right.
Do any of your clients run into that where the lender is having an issue with the fact that the return has not been accepted? They can't see it as processed on the IRS website. Is that familiar to you?
Yes, I've had one situation. It wasn't on my end of the transaction. I was dealing with a buyer here that's buying here in Texas, but they were selling a property in Florida. That buyer that was buying their property in Florida, we were having that issue with IRS where it wasn't showing any information, and we were dealing with those delays, which kind of it did cause some issues on our end. We finally made it work, but yes, it was a headache. It was very stressful.
Okay. Yeah. So, amending is an option. I don't like it because of the time it takes.
Exactly. Especially if you're under contract. I mean, it could literally be a deal breaker. I know it's sad, but when we have these contracts that are either, somewhere, on the average 30 days to close, that's not enough time to amend a return if that's what the lender is needing, which is why it's more important for the buyer to get everything together lined up with their CPA and the lender, have everything ready to go before they start looking at properties or submitting offers on properties, and much more important than being under contract, because you don't want to deal with that on the back end. It does cause a lot of delays.
I got a question.
Yeah. Go ahead, Melissa.
Hey, Danny, can you tell us about, we talked to these buyers, and a lot of them are coming in as renters, longtime renters, and we always talk about, hey, owning your own property, it's very important. You can build equity. There's advantages to home ownership. Can you talk about any advantages through taxes for home ownership for buyers?
So the most advantageous situation for a home buyer is to be able to write off the mortgage interest and the property taxes. Unfortunately, those numbers have got to be high. The property tax, the property tax and the mortgage interest and charitable contributions, those are the three main itemized deductions. Those three numbers have to be more than the standard deduction. So if you are a married couple, that standard deduction is around $25,000, I believe it is.
Okay.
The standard deduction for a single individual, a person that is not married and has no children, that standard deduction is $12,400, I think it is. So if you're married, it's going to be difficult because the mortgage interest and property taxes usually are not more than $25,000. The property taxes that you pay, those are limited to $10,000. So that's a disadvantage if your property taxes are 12 and 15 and 18,000. The mortgage interest, the first few years, that will be helpful because it generally tends to be very high. Yeah. That's the highest at the beginning of the note. If you're a single individual, that's probably good then, because you can afford a big house, lots of property taxes, lots of mortgage. You will be able to deduct it because those two numbers can be way more than 12,000. Right. If you are a single person and you have a child, you can be classified as head of household, which that standard deduction is around 18,000 or so. It's 18,600, I think. It doesn't matter. Then your property taxes and your mortgage interest, again, you got to be more than 18,000. So you might be able to deduct it. You might not. Just really all depends how much you bought, how much the house is, how much your note is, things like that. Also, again, charitable contributions, money to the church, money to Austin Pets Alive, nonprofits, donations to Goodwill. What's the other one? Texas Veterans, I think it is. Okay. Your household items, your electronics, those all are part of charitable contributions. One of the third items for itemized deductions. You speak about value, Melissa. Yeah, that's another good reason to purchase a home. You purchase this home, you live in it for several years. Hopefully that the value stays high or increases. It turns out to be an investment after you've lived in it a while and you are able to sell it for more.
Absolutely. Yeah, that's a great question, Melissa. Yeah, thank you, Danny, for that. That leads to, hopefully, are you guys okay if we move on to the seller side, or unless you guys have any other questions on the buy side of things?
No, I mean, it's funny that you talked about the request for, what were you guys talking about just prior about an amendment?
An amendment, yes.
I just have to tell you all a crazy story. So
yes, please do. We love stories. No, we love stories.
So I had this buyer, she's a first-time buyer, and she had a property in, I want to say it was a little town towards West Texas or something like that. She was not originally from Texas, but she took a job with a federal government or state government job, and she went to this little town and she bought this little house. And she's like, oh, I'm going to make, good money. Well, she realized, I don't want to live in this little town anymore, But, she made a smart choice to buy a house. She bought a little house, and the mortgage wasn't very high. So she ended up getting a promotion, moving to Austin. She's like, I don't want to be in that little town. Well, she didn't want to sell her house. So she ended up renting her house, right? And something happened on her CPA missed that she wasn't reporting rent.
Oh, okay.
So the lender approved her here for a house. It's actually here in Maynard, where I live. And, we snagged the offer, we snagged the house, and we had to keep asking for extensions. And this was right in the beginning of COVID.
Mm-hmm.
And it was low staff everywhere. Okay. But it ended up being, she didn't get the house. So that was like a really sad story. But I can't tell you how important it is for those details. And Danny can probably concur. Something like that was pretty major in her. And it was actually, it affected her ability to qualify. It affected her debt to income ratio because it showed that she was holding 2 mortgages.
Oh, gosh. That's horrible, Melissa. I'm sorry about that.
Yeah, but anyway, it just shows the importance of having a CPA like Danny, who's on it, can take care of it, and will not miss those things. Important to have a good rapport with your CPA so that you can explain what your goals are, right? I'm a homeowner here. I want to end up buying an investment property. What are the suggestions you have? CPAs, they can help you with that. Right, Danny?
That's right. We do our best.
Absolutely.
Sorry about that guy.
No, yeah, I know that's horrible, but gosh, man, having everything prepared. I mean, just more emphasis on, I think a lot of us try to do everything ourselves, and it's just to show you that we truly need professionals or a good team by you, such as a CPA or a good lender if you're financing, a realtor to help you find, especially in this market. So I'm glad that Danny is here with us. And guys, just as a reminder, I don't have his information in our YouTube channel yet, but I will be plugging in that information. So if you need a CPA, I will be in the bio, linking in his information so you can contact him directly if you do need any CPA services. He can definitely help you with that. He's very knowledgeable, and I'm very happy and excited to have him here. So moving on, if you guys are okay with the seller side, a lot of folks are either have in the middle of trying to sell or getting ready to sell. I don't believe we have that season anymore, but a lot of people feel it's that season again to start selling their home, or they're looking always in the spring or summer to get their home ready to sell. One of the top questions is capital gains taxes. So, Danny, do you think you can maybe let us know a little bit more information on how that can affect a seller's ability to sell, what that means to them?
Yeah, sure. So as a lot of people probably know, when you sell your personal residence, there is an exclusion to exclude the gain on the sale of your home. If you're a single individual, that exclusion amount is $250,000. If you're married, that number is $500,000. That goes for if you're a head of household as well. It's $250,000. You're basically it's basically $250,000 per person.
Right.
So when you purchase your home a long time ago, say for $150,000, and you end up selling it in Austin because it's crazy for $800,000 or something. If you're married, you can exclude $500,000 of that gain, which is a very big help. And if you're single, you can exclude $250,000 of the gain.
Absolutely.
That's let's see here. So also, what would be very interesting to know is that there are 3 capital gains rates that you will fall into. The first rate is 0%, second rate is 15%, and the third rate is 20%. So
can you repeat that again?
Yes, there are 3 tax rates for capital gains: 0%, 15%, and 20%.
Okay.
The criteria on that is if you are a single individual and your gain is 80,800 or less, you will be in the 0% tax bracket for your capital gain.
Nice.
If you're married, let's see here.
This is good information.
Yeah, that's really good information.
I'm just,
You
excuse
think
me.
so, Keena, right?
Yeah, I didn't know any
Yeah.
of this.
80,000 for married filing joint, 80,800 for married filing joint, 40,400 for single.
Okay.
Head of household is 51,100. So as long as your gain is below those numbers, you will be in the 0% tax bracket. After that, you get into the 15% bracket.
Okay.
Let's see here. I will have to double check the numbers for above the 50 or how you get into the 20% bracket.
Right.
But those numbers are 445,850 for single, 501,600 for married joint. So you'll need to discuss that further with your CPA, with your tax
Definitely.
preparer. If
Because
you use
you might be-
TurboTax, yeah, there's probably a little bit more information to that. There's also moving parts to your tax return that
Right.
determine whether or not you get into that 20% bracket. So good for you. I hope you do have those problems.
Right.
Because that
right.
just means you got this giant gain. So that's great.
Exactly.
More money?
Um,
More. Tell me, Keena.
No problem.
Yeah.
More money, more what?
Mo problems.
No problems. I'm kidding. It's like you said, it's a good problem, right?
Yeah. But when you do sell your home and you are able to use the exclusion, you do have to sell your home and do another exclusion. So the actual rule is, you must be in your home, have it as a personal residence for 2 of the last 5 years. Then you're able to use the exclusion.
Mm-hmm.
So supposing year 1, you purchase your home, you sell your home in year 3, and then you buy a new home. Well, you can't turn around a year later, year and a half later, and sell it and use the exclusion again. You have to wait a total of 5 years. So after year 5, you are now able to sell your home again.
That is so
and
important.
use the exclusion.
Thank you for that. That's so, I think a lot of
Yeah.
people are in that boat right now. Either they have
Right.
several properties or
I do.
Right.
yes.
I sold.
Yes. So that
Yeah.
really matters. I mean, all these things that they don't really think about, you know what I mean? They don't think about, which is why I always, when we get these questions, right, as realtors, we are normally on the front end of everything. So it's normally one of the biggest questions, what's going to be my net proceeds? What about taxes? And that's normally when I start deferring people. You really need to speak to your CPA about that, because it's a bit, just like you said, Danny, it's a bit more intricate than that, right? There's other moving parts that will affect the entirety of everything. So definitely
Right.
speaking to a CPA would matter. So Danny, does that apply also for, I know you mentioned when someone buys their house on year 1 and then they sell on year 3, purchase another one, they would have to wait either, did you say at the 5th year or after that 5-year mark to be able to sell it, to have that exclusion, right?
Right.
Does that apply for someone, let's say they have 2 properties, right? Or 3, and they sell one because life happens. It could be related to a divorce, or it could be any other thing, but life happens. They sell one of their residences, their primary residences. They move into one of their investment properties. And let's say a year and a half passes and they want to sell that one too. How would that work?
The rule is is every 5 years.
Okay.
you can use the exclusion.
Okay.
But you have to
Otherwise,
be in that. I'm sorry, Melissa?
Otherwise, you fall into the 0, 15, or 20, right?
Yeah, otherwise you cannot exclude any of the gain.
Got
You
it.
can't exclude any of it. As long as you wait the 5 years, you can use it again. Now, supposing that you sell your house in year 3 and you rent, and you can't get into your second investment property because you got renters in there, it's making good money, but you've had it for 5 years. Well, in in the first year that you get into it, that starts your 2-year time period. It doesn't matter that you've owned that property for the last 5 years or 8 years.
Thank you.
You have to live in it for 2 years. Yeah, that is to be your personal residence. Do your clients ever ask you, how do I prove my personal residence?
You know what? No, they haven't. They ask me in general, and honestly, that's not my area of expertise. I always say, you really need to get with a CPA. But no, go ahead and let us know, because I think it'd be good for the audience. Again, guys, disclaimer, you need to get with your CPA or get with Danny, right, on any questions you may have. But go ahead and sit and let us know, Danny.
So I have not been into a situation where an IRS auditor makes a taxpayer prove that it's your personal residence. But my suggestion would be, number one, you have that address on your tax return. Okay. Have the address on your driver's license. Show that your driver's license says that. The next thing that could help is if you use that address for your children's address for school or maybe at the church. One other thing is the homestead exemption. You can only have one homestead exemption here in Travis County, and I also presume in the state of Texas.
Yes.
So I was at house number 1. This was my homestead exemption. I sold it. I moved into my investment property. I purchased a new home. I contacted the county and I said, this is my homestead. That's another good way to prove that that's your home, that's your personal residence. Those would be the items those would be the things that I tell people when they come and ask that question.
Exactly. That's awesome. That's really good to know.
Danny, I had a seller, oh gosh, I guess this was last year. I think it was last year. Okay. In the hype of COVID and crazy house prices and selling, and she sold slightly under 2 years. And, I told her, you need to get with a CPA. You're going to probably be paying some capital gains because you're under the 2 years of ownership. And she says, oh, I'm not worried about it because of the reason for my move. And I said, well, what is the reason for your move? She was like, my mom is ill and I have to go home and take care of her. So I have to sell my house. And she's like, there's some exceptions that can be made. She was not concerned about the 20%. I didn't know at the time about the 0, 15, 20. She sounded like she knew she was not going to pay capital gains based on that. And I think I might have called you around that time and says, have you heard of this? But I don't remember. I had to pull myself out of it and tell her to call her CPA.
Yeah, for sure.
Yeah. The only thing that I can think of as an exception for that 5-year period is that came up with my brother-in-law. If you are moving for your job and your job is more than 50 miles away, then yes, I do believe that you can, that is an exception to the 5-year rule. I'd have to look at that.
Okay.
She moved to the valley. She moved from Austin to the valley.
Yeah, that's definitely,
Well, it has to be 50 miles, but I believe you have to prove it for a job. If she retired or, just quit working and she didn't work anymore, I don't know if that would have qualified. I'd have to double check that.
Yeah.
I think her husband held the bread, or was a breadwinner, whatever you want to call it, and his job moved him to South Texas.
I'll have to look further into that. I would be worried about the fact that only one individual is working, not both.
Right, right. It's crazy to think that all of these details are so important because the IRS does look into that, which makes me nervous about answering any of those questions. I'm like, you really got to get with your CPA because it's not just about the house. There's other things in there. I mean, what's your motive, your reason for moving? Or, you know what I mean? Like all these things that are really important to know up front to see if the capital gains exclusion will affect you or not, or if you're even going to get it. So I think that those are all good points, Danny. Thank you for that.
Hey, Keena, are most of your buyers W-2 or 1099? Or what have you noticed?
W-2. I've had, I want to say maybe 2 that were not, but they made enough that it didn't make such a big of a difference, and they were still good to go. So it's never really been a big issue for any of the buyers because most of them are W-2.
Yeah.
But I did have a seller that I think this was last year as well, that they were not married. They were both single, but they bought the house together and they had to sell within a year. So they had bought the property and then sold it within a year, and they were worried about the capital gains as well. So I don't know how that works if you are both on the property, but y'all both file as single.
Oh, that's a great question. I would think that's a good question actually, right? If you're filing your tax returns separately, but you bought the house together, that's a great question, Keena. How would that affect, would that be something that they're automatically going to get or in this case, it would be within the year, so they probably have to pay capital gains tax, but I would imagine if it was after the 2-year mark, that would probably play out differently because they are filing their tax returns separately. I'm not sure. How does that work, Danny?
I have not come into that situation, but my first answer would be that there's 2 owners and they're both on the title to the house. Is that right?
Yes.
Yeah.
Okay. And then they file separate tax returns, single head of household or something like that.
Exactly.
If I'm not mistaken, the way that I would handle that is to split the cost or split the amount of the sale. So if you sold it for $650,000, that'd be $325 to each seller, and they would get they would split the basis as well. The purchase of the home, they bought it for I don't know, $100,000. So that is where that's what I would say to that, is just split it all down the middle. I would have to double check on the house itself if there's any rules to the IRS that says you can only do it per home or something like that. I would have to double check that.
Yeah, that's a great question, Keena. I think that is something that a lot of people operate under the assumption that if they bought a property together, it also matters if you filed a home your taxes together as well, or if you filed it married jointly or married. I think all of these details really do matter. So it's one of those things where you really got to discuss, what will it mean, right? This is our situation. What are the net proceeds if I sell, minus the mortgage, minus everything else, the cost? Because you can, I would imagine, deduct all the fees that
Interest.
are exactly interest, everything, the mortgage, the cost to sell the house, whatever's left over, then you can kind of work it out from there. And that's what the CPA would want to know as well. But more important than ever to get with a CPA if you are thinking about selling, because it does matter. So you just never know.
I have people, I saw a lot of houses in my area this past year, and there were some where they were definitely under the 2 years.
Yeah.
And because they were making an extreme profit, like an unreal profit, some of them were moving for jobs, some of them were not. And, I recommend they talk to CPA. But anyway, I just wanted to put out there that you would be surprised how many people did not care about the capital gains, because they were going to make so much money that, they figured, it would be a lot of people knew it'd be between 15 and 20%, but they were still okay to pay because of money. And a lot of them, it allowed them to move into a bigger home, in an area that they wanted to live in. So for them, it was advantageous to sell at the height of the market, because they thought, I may never get this price for my house again. I need to do this right now. Right.
Yeah, and I don't think it's a matter of not having to pay anything. It's just weighing out, right, if it's worth it or not, and if it will affect you, right? Or if you even knew about that you would have to pay 15, 20%, or if you fall in within the 0%, or if you qualify for the exemption, right? All of these things matter, because if you're down to the nickel, then it may matter. But if you have some wiggle room, then it may not affect you. But it's still good to know, so you know your bottom line.
I don't know. I feel like there's going to be a lot of this capital gains going on in Austin.
Yeah, for sure.
Yeah.
I just thought of something else that your clients may want to know that would be important, and that is to determine what your basis is in the property. Do your buyers ever sellers ask you about that?
No, I haven't had any sellers ask me. Go ahead, Danny,
Okay.
if you want to dive in a little bit deeper on that.
Yeah, so when you go to calculate the gain on the sale of your home, you need to know what your basis is, or what's called your adjusted basis. So basically, what did you buy your house for? I would ask for a closing document from when you purchased your home. You purchased your home for $150,000, but there are costs that you paid. So your total purchase price is $155 or something like that.
Okay.
That would be your basis, the $155,000, not what you put down, not what you've paid so far into your note. It would be the total price that you were on the hook for.
Right.
The next thing that you would want to do is to count the improvements to your home. And that might be, that would be a judgment call. So what's an improvement to your home? Well, a new roof would count. Your roof was bad or it wore out. That would be an improvement. The improvement, basically, it adds value to the home. Solar windows, solar energy efficient windows, solar panels would be good.
What about window coverings?
Say again?
Window coverings.
Window coverings, you would have to basically add value. So
Like, for example, my shutters.
They weren't cheap.
They weren't cheap, but it helped make my house energy efficient and it brought a lot of value.
yeah, so if you can get a certificate from the individuals who sold you those shutters that they are proven to be energy efficient, yes.
Okay.
Just because they cost a lot and just because they look pretty, no, that would not be an improvement. In
Danny,
fact, that
keep
would,
it real.
yeah. I don't care about pretty. I'm just kidding.
Danny. He is keeping it real.
So that sort of thing, that wouldn't be counted as an improvement.
Okay.
Repairs also do not count. You had a busted water pipe and it ruined the floor. No, that is a repair, not an improvement. It does not matter that you paid $5,000 to the plumber to fix the pipe, to fix the drywall or what have you. That's just a repair. So if you can, it'd be important to keep receipts on all those improvements.
Gutters? It helps. It does improve the value, I feel, because it keeps up with the foundation. Thoughts, girls?
I think so.
It's tricky. And well, I guess
that's a tricky one.
Yeah, there's a lot of, like, with the solar panels, you know what I mean? That one's tricky too. I mean, it depends. So
ultimately, it will come down to an argument with an IRS auditor who says, yes, this is an improvement. No, it's not, kind of thing. So get your arguments ready to go.
Exactly.
Yeah.
So the cost of your home and any improvements to your home, that will increase your basis, which will in turn lower your gain.
Right.
The other thing that will affect your basis is whether or not you have a home office and whether or not you take a deduction for your home office. So when you have a home office, as some of your self-employed individuals will more than likely have, the one deduction is depreciation on your home. So how much was your home worth? It was worth, $300,000. Take that number, divide it by 27.5, and then take the percentage of your home office, and that is your deduction. Let's say it's $500 a year.
Right.
It might be a little high, but let's just say. Well, you've used that deduction for 5 years, and you're ready to sell your home. Well, that $500 for 5 years, $2,500, that is now taxable when you sell your home, because you've taken the deduction against your income, and you have effectively lowered your basis by that $2,500. So home office deduction is a good deduction. It's a valid deduction. But when you go to sell your home, you will be subject to that recapture of depreciation. So be aware of that.
I wonder
So
if there's
we
like
have
a, go ahead, Keena.
I was just going to say we have a question from Joanne from the live. So she says, how does a homeowner keep track of all the upgrades that add value or is considered an improvement? And is there a list of some sort to know what all is actually considered improvements?
I do not believe that there is a list. There is IRS publications that talk about it, but you basically have to prove that it adds value. It's an improvement. It's not just a repair. As far as keeping track, save your invoices. You know, the company that you paid the $10,000 to improve your home, you have to save that receipt.
Right.
That's very important. Funny, you said I've seen a bunch of different things. Just this year, I have a client. I've been with him. He's been my client for the better part of 15 years. He brought me a very thick stack of invoices that he has saved over the last 20 years to prove his basis in his home. So it's valid.
Yeah.
It's valid. The improvement that you did 20 years ago, you're ready to use it here in 2022. That's a valid improvement. You can use it, but you have to have the receipt.
Right. You have to have the proof.
I really recommend saving your receipts.
Absolutely. Gosh, not a lot of people think about that.
It's interesting that what you call improvements and what we would call improvements in real estate, or what IRS would call improvements and what we call improvements,
they're so
are
different.
not the same.
Yeah, they're so different.
Yeah.
But it's still good to keep the receipts, just as you said, Danny, because you never know when they'll come in handy, especially if you're trying to save or not pay as much in taxes.
Correct.
So you just never know. I would just save it and if you have a big, thick stack like Danny's other client did, or if you have a small stack, that's what your CPA can handle and help sort out to help you out with that.
Right.
So that's great.
We're in the era of people who throw receipts away.
Ugh.
That's me.
Look at Keena. She raised her hand. I'm a Generation X. I keeps all the receipts.
I don't. No. I'm just like, I can always look at the bank statement, but that's horrible, right, Danny? That's bad. I'm probably
they're younger than us. We're the generation.
They are.
We're the generation of ledgers, and they're the generations of smartphones and whatever. I don't know. They're younger than us.
It's okay. It's okay.
I'm not a big fan of the bank statements. I'm a fan of the receipts, the invoices.
Right.
So good luck.
I knew you would say that. I was hoping for some magical words to help me and give me some hope out there that it's okay. You can prove it with a bank statement.
Right.
That didn't happen.
I'll just say good luck to them.
Yeah. And that's perfectly fine. I did have a question. Let's see. I got it earlier, and then I'm trying to think about it again. So for the sellers, okay. So now that we talked about the homestead exclusions, I know it can be a little bit tricky, just like you said. What about for anything on the investment side that maybe you can inform us a little bit more? There's investors out there that utilize a 1031 exchange if they're going to purchase a like-kind property. Do you see any investors come to you that they're not going to purchase another property? How do you help them to minimize what they're going to pay? Or is it just a straight rule like, hey, you sold, this is exactly what your capital gains tax is going to be?
Yeah, there's not too much to that. I would have to look at the improvements.
Yeah.
You know,
okay.
If you purchased a home and you rented it out, the improvements would increase your basis. What's also a lot of people don't know, or I find clients that don't know, when you do purchase an investment property and you are renting it out for several years, your basis does decrease as the years go on, because when you rent it out, you take a depreciation deduction on that house. So again, you buy a house for $150,000, you divide that by 27 and a half years, and that is your deduction on your rental property.
Okay.
So every year that goes by, your basis goes down 150 to 145, 142, so on and so forth. Then when you go to sell that house for, 400,000, well, you've depreciated that house down to 90,000. So it's 400 minus 90, that is your gain. And that's what you're going to be subject to tax on. Obviously, improvements will increase that number.
Right.
So I do have a client. He bought a house for 180 or so, and he bought this thing about 20 years ago, and he's ready to sell it. It's going to be a good $900 million sell. And his basis is like 30 grand, So that is a giant gain, but that's what happens when you have an investment and you are renting it out. Now, I've had other clients say, well, that's not a good thing. My base is going down. How about I just don't take the depreciation on my tax return? I just don't claim it. That does not work. That does not work because your basis in the property is subject to depreciation, whether you take it or not. Okay. So if you decide, no, I'm not taking the depreciation, under an IRS audit, the auditor will depreciate that thing and lower your basis, regardless of what you put on your tax return. But at the same time, your other strategy for doing that is, okay, I've depreciated this house quite a bit. Why don't I just move in it and live in it for 5 years, and I'll take the exclusion, I'll take the personal residence.
Right.
I would do that.
Exactly.
Yes, you did buy it for 150, and yes, your basis is now 90,000. Well, you move into it and you eventually sell it, your basis is 90,000, and you'll save at a minimum 250,000 on gain. You do have to live there, but how much what are you willing to do to save?
Exactly.
Are they basing that on an investment loan?
What do you mean by that?
When you say, hey, this person had a house, they purchased it as an investment with the intention of renting it, and they're like, let me go ahead and move into it. Is there a time frame in which that needs to happen, or it just doesn't matter? They just move into it?
No, I don't believe there's a time frame on that. No. 1031 exchange is a good deal as well. You basically defer your gain to a future year. That does not work with the personal residence. Yeah. That is not available to a personal residence. It would be just investment properties. And as you know, it has to be like kind.
Yes.
Do not sell your house and go buy a yacht.
Yeah.
That will not work.
So I had another question for you, Danny, on that subject. So I have a client that has several investment properties, but he's trying to think about, should I sell one of my investment properties and use those funds to purchase a primary residence, right? Something that he's going to look into moving into. And I told him, like I always do, I'm like, you really need to get with your CPA on that. I mean, there's many options to try to help someone out to avoid paying that much in taxes. And that one, I'm like, because he asked me, he was like, can I do a 1031? I'm like, well, if you're going to buy a primary residence, technically you can't, because with a 1031 exchange, it has to be from investment to investment, like kind property. And you're going from investment to a primary residence. It's just not going to work. So you're unfortunately going to have to pay a capital gains tax. And then in the Austin area, over the years, I mean, there's going to be quite a bit of equity on there, which also alternatively means more capital gains tax. So what have you seen, aside from the other stories that you have told us, what have you seen investors do on that end? I wasn't sure if you came across those scenarios recently or in the past.
Not much. I do have a client that has 1031 exchanged for about 5 properties now, going from one to the next. There's not a whole lot you can do. The other thing that could happen if you're in this situation is to 1031 exchange into 1 or 2 properties. And that's I don't like saying this,
Yeah.
but I'll say it. When you pass away, that property goes to your children, to your
Right.
heirs, and they get to step up in basis, you know, and you've effectively avoided the gain and increased your value through 1031 exchange. And now that's all basically tax-free to your children.
That's great to know.
That's a pretty rough way
Yeah.
to go about it.
Yeah.
That's for sure.
Yeah, for sure.
But that's something that's possible.
Exactly.
Can you give me some good news, please? Oh, man. It's like, you know, we're in the real estate business, we encourage our clients, purchase a home, get an investment home. There's advantages, rent it out, have someone pay your mortgage. Then you come into this basis business and it's like, well, you know, your property ain't worth a caca, you know. But I say this because, you know, I'm not a senior investor by any means, but I have investment properties. And I do this because I want, you know, I want to have something. I want to have something that could help me into retirement. So, you know, give us some good news about people like me who like maybe bought a beach house and a rental house. And, you know, is this bad for me?
Good news.
No. The only way that it would be bad for you is if the value goes down. So just make sure your investments don't go down. That would be the thing. But yeah, I mean, I totally support people investing, purchasing homes, you know, as long as you can get them rented out and you make some money along the way. It's always a good thing. We all should try and do that, I guess.
Yeah, exactly.
To a certain degree. I personally do not worry too much about paying the taxes because, you know, they're going to be there.
Yeah.
I personally try not to worry about it very much in the sense that, oh my God, I don't want to sell it because then I have to pay a lot of taxes. I don't follow that. So,
right.
But you know, the 1031 exchange, I mean, it is a good vehicle. I mean, it really is, especially if you're a long-term investor.
Exactly. Yeah, I'm glad you brought that up because that's a good way. I know we were kind of discussing on the exclusions and exemptions for the 250 single owners or 500,000 for married couples, but we really didn't dive in on the investment side because investors also own property and they may want to know a little bit about this. So, Danny, I had another question for you. Do you ever get any clients that, aside from the general CPA services, they actually have a plan that they want to achieve? Do you ever get anybody that wants to hire you for your services and let you know, hey, my plan is to be able to purchase X amount of homes. How can I navigate this? What do I need to do? I mean, do you ever get anybody like that? Or is it just as whenever they need to sell a home, they get with you and ask you questions? Or is it just taxes? I'm just kind of curious what people are coming to you for, and maybe you can help the audience see that. That way, maybe you can help them as well if they ever needed your services.
Yeah. No, I don't think I've ever had that specifically. I mean, I do have clients that have a handful of different rental properties. There's nothing really too extravagant about it other than you have, 3-4 rental properties. And, people ask me about an LLC.
That's a good one.
The LLC? Yeah, do I put the rental house in an LLC? And my answer is, yeah, you can do that. The main purpose for the LLC, putting a rental property in an LLC, is so that to keep from legal liability protection. Melissa, you have a home and I rent it from you. And my child falls off the balcony and hurts himself really bad, and your balcony was no good, and I'm ready to sue you. I'm not a lawyer. I want to make that very clear. I'm not a lawyer, but from what I understand, I will be able to sue the assets to the LLC, which would just be the rental property. I don't believe that I have access to your personal bank account, your car, your house, any of that stuff.
Yeah.
Say again?
Your firstborn, your house, your car.
Right, exactly.
Your Louis
Vuitton. So, yeah. Well, I wouldn't want your Louis Vuitton purse, so you can keep that. Anyway, So that's, that's something that I would tell people is like, yeah, do an LLC for it. That'll be fine. You wouldn't have to file a whole separate federal return for that. You'd still keep it at a personal level. I believe it's called a series LLC or something like that. You can create the series LLC and put all of your rental properties into the series, and you still have the legal protection, I believe, to each one. So you'd have to talk with a lawyer about that.
Right.
But as far as, a plan specifically to that, Liza, no, I don't think I've ever had that situation before.
Okay.
But yeah, I'd certainly help anybody who has questions, and, we can talk about what they want to do, what they're trying to do. And I basically just give the tax benefits and tax consequences on that.
Go.
So,
and that's exactly, that's really what they would need you for, to know that, since you would you're the go-to source for that. So it's definitely important to know. So thank you for that.
Sure.
Wow, Danny, you're smart.
I know. This is a lot of information.
I do have been doing this a while, and I've ran into quite a few different things. So,
a little tidbit, y'all. I've known Danny since grade school.
Oh my gosh.
Yeah.
We won't say how old we are, but
no, I'm not gonna. Del Valley, right? Or
yep, that's right.
Del Valley. There you go. That is so crazy.
Amazing.
That's awesome, Melissa. That's so cool. So guys, we are ATX Homegirls. Again, thank you for being with us tonight. And Danny, thank you so much for tuning in and providing such valuable information to our audience. So again, Danny, I'm going to plug in your information here in a bit when I do end this stream, so that way people, the audience, know how to get in contact with you if ever they need your services, or if they have any questions about tax implications, anything tax related, consequences, good things, income. I'm sure that you can help them with that. I will plug in your information there. But again, if you don't mind telling the audience that maybe have tuned in a little bit late into the series here, who you are, how long you've been in the business, what you do, and I will make sure to relay that information again in our YouTube channel.
Okay, Danny Pena. I'm from Austin, Texas. I've been in this industry, tax preparation industry, since 2002. I got my license in 2015. I've been on my own since 2015. I file predominantly a lot of individual returns. I have a lot of S corporations that I file for individuals. I do a handful of partnership returns and a little bit of nonprofit returns. I don't really do too much auditing of companies, but I've been doing a lot. I've seen a lot. I've heard a lot, and a lot of it's been funny and scary. So try not to be too scared of the IRS.
Right.
As long as you talk to them, as long as you communicate with them, they'll be okay.
Right. Thank you so much. Yeah.
We do appreciate you taking your time out. I know how busy tax season is. I know you probably sleep at your office like most CPAs do during this time of year.
Yeah.
Thank you so much. I know you've got to get to dinner with your family. So thank your family. Debbie, Gabriel, where is she at?
They're hiding.
Isabella and Debbie, thank you. So yeah, you guys, thanks for tuning in.
Yeah, thank you for tuning in. Again, don't forget to like and subscribe. This will really, really help us reach more audiences out there that may benefit from the content that we're sharing with everybody. Oh, hi.
Hi, Isabella.
Is that Isabella? Hi, nice to meet you. That's so awesome. And we are ATX Homegirls. Thank you again. And Danny, thank you so much for taking time away and sharing information with us and with the audience. So again, guys, tune in every other Wednesday at 7 p.m. So not next week on Wednesday, the following week on Wednesday at 7 p.m. we'll be live. And